more than 2 dissents, 3, maybe 4. So, is more dissents better? Does it protrude uncertainty within the board? There's a lot of things going on. The labor market, we know that there's certain governors. Lisa Cook is more focused on the labor market versus other participants, but there's still this overhang of inflation. And then you got the dynamics within the labor market itself, the supply side with immigration, the demand side. So it's going to be a cut to stimulate, a little bit of demand. I think it's all about, is it going to be a sell the news event finally after we've gone pretty much up after months.
I mean, how can this not be sell the news considering the positioning of pricing going into it and the reason we're going to cut rates? I don't know if you said there's a Tom Keene over at Bloomberg was circulating a chart earlier that was showing the labor market participation rate for men going from like 85 to 6. Like, I just think that I don't see how the labor market is not going to become a problem because of the AI supernova. And I don't see how cost pressure is not going to become a problem because of the tariffs.
Well, so this is really the essence of what the dance is here. So take a look. I have the Fed funds futures implied outlook here, and we can see the market is increasingly cemented around a 25 basis point move. So this was a week ago, and this was a month ago. So you can see that what you're seeing is consensus build around this this cut, and the chance of a 50 basis point cut, you can see a week ago was higher, yesterday was higher, now is only 3.9%. So the market is kind of cementing around what this idea is, and increasingly it's, look, we're going to get a standard cut. It's going to be a 25 basis point cut. I think Thomas is absolutely right. It'll be a question about the messaging. The SEP is, in my mind, the biggest thing. But of course, Powell is then also going to do a song and dance, and we're going to find out what that's all about. I think the interesting thing here is we can, of course, rattle off all kinds of things, right? We can go down the list and say, well, obviously, we see that goods inflation, while still lower on the whole than services inflation, it's also at a multi-year high. It's been going up for 4 months straight. We can see that the tariff thing is making its way into inflation. I mean, that's clear. We also see that the labor market is soggy. That's clear. The revisions were terrible. The previous number was awful. If we look at the revisions and the previous number together, we added 22,000 jobs. We revised the preceding 2 months down by 21,000 jobs. So we added 1,000 jobs. Great. Wonderful. Not good. So when we look at the sort of aggregate picture, it doesn't look good. This is where sort of the market's perspective on all of this and the clash between the Fed and that perspective is really big. Because the market sees all these things and goes, right, so you're going to have to cut a bunch more times. And the Fed has just not owned that. And there's a disconnect. Because even in that Powell speech at Jackson Hole last month, where he was waxing on about we need to start thinking about making a move and this and this and this, he does say risks to inflation are tilted to the upside, and risks to unemployment are on the downside, and then says, look, we cannot allow one-time increases in price to be an ongoing inflation issue.
So how do you stop the price increases in services? Why are services prices increasing? Because it's not inflation related. So when you have a weakening labor market and services prices are increasing, do you think that's going to be a question mark that they address?
So this is going to be, I think, a very interesting part of it, because what we saw in the last inflation report was that core services inflation actually fell. Now, it fell only by a little, and of course, core services is a much bigger overall part of the economy then is goods. So if the economy is 70% service sector, give or take, then most inflation is going to be there just because that's most of the economy. But the directional impetus has been higher goods prices, lower services prices. So that gives you that sense that the economy is slowing. So, but you don't see it in the overall data. The Atlanta Fed GDP Now tracker, never mind that it's way too early to really make a call on what the GDP is going to look like for the third quarter. That data is not going to come out in a while, but take a look at the direction of the data. So just look at that green line there. What you see is that the tone of the data has been higher. Now, does that mean that the economy is reheating? The PMIs suggested. So that's a bigger inflation risk. It hasn't metastasized yet in the CPI data or in PCE, but you can see it. And so it's an interesting sort of thing. We heard in the minutes, we heard from Powell, they're still looking at inflation as the greater risk. So if they're cutting for the wrong reasons, if they're cutting because growth is weakening, that's one thing. That's probably the worst of all possible worlds, to Dylan's point. But
well, I mean, where I'm going, I mean, what I'd be interested to talk about is if this thing's going to come unglued a little bit, where is it going to come unglued? Mm-hmm. Is it in the supernova stocks, or are they actually the most immune? Is it in gold?
I think if it's growth, so the reasoning here, I think, is hugely important. My sense is if it's a growth risk that has people worried, if the Fed essentially comes out and goes, here's all your easing, and by the way, here's more, and we're slashing our inflation forecast and our growth forecasts because, oh my God, are we ever in business cycle defense mode? I think the markets aren't going to like that, obviously.
But again, where do you think that plays out? Is that in the NASDAQ?
Well, so then the Mag 7s probably actually look a little bit better because they're probably more immune to a growth risk than elsewhere. And then I think sort of the place where you'd expect the most pain would be here in the Russell. Mm-hmm. These one would think these are the most vulnerable names to a business cycle turn. And if you look at where we are here, I mean, obviously we're at record highs for S&P and NASDAQ. We're not there on this. Mm-hmm. And we do seem to be kind of squeezing into a sort of wedge here, which can be indicative sometimes of momentum essentially squeezing in before it gives way. So if you look at this with a technician's eye, then what you'd say is, here is a rising wedge. It's telling you that you're still going higher, but momentum is getting squeezed in. So the swings are getting hemmed up. And even though you're setting higher highs, you're not setting them on, choose your momentum indicator. I like RSI because it's simple. And that this would be sort of a classic into a top sort of setup, but you would need confirmation on a break, let's say, through this line somewhere here. So if you end in the red by a meaningful margin tomorrow, then you get a real clean signal. Mm-hmm. If instead the way that the Fed disappoints isn't by going, oh my God, growth. If it disappoints by saying, you all have baked in 130 basis points in rate cuts from now until the end of next year, and we're still at 75 at best. So we're like half as dovish as you are, and we're not going to give you all this easing. You're nuts because the risk is inflation. Then the market is disappointed, but then it's a very different kind of a thing. Then I think maybe one of the more, well, I mean, certainly NASDAQ looks awful in that sense because the supernova arguably depends on there being cheap money to power
Does it though? I'm not. I almost feel like the supernova is. I mean, this is obviously the sort of comment that gets sort of jammed in your face later, but I
Right.
really feel like the supernova is a freestanding entity. I don't know how. I mean, I understand how housing or sort of oil rig development in the Gulf of
Yeah.
Mexico or the building, new infrastructure, energy infrastructure, transportation infrastructure is very sensitive to the cost of capital.
I think there's two things here, and I agree with you. I think the supernova is freestanding, but there's, in my mind, and Thomas, weigh in on this, see if this makes any sense to you. There's the supernova, and then there is investment capital betting on the supernova.
Totally. I see where you're going. And
Like the supernova is doing its thing, right? It's a freestanding thing. It's going, it's whatever. The question is how much of that is already in the price versus not.
And how much is sentiment around the liquid public equities that represent the idea of the supernova?
Yes.
How much of that really is just sentiment at the end of the day? Obviously, all of it is sentiment, but how much of that sentiment is how far detached from the reality is the sentiment, which is obviously the billion, million, $1 trillion question,
right?
And how dependent is that sentiment? Listen, the economy's slowing down. That's not a speculative statement. The Fed doesn't.
I mean, the Fed is saying it.
Yeah. So the Fed is not cut interest rates because the economy is getting hotter. They're not like, this thing's really heating up. We better reduce rates.
Yeah.
Like they reduce rates because they feel like inflation is under control, or they have some version of comfort with whatever inflation is, and there is evidence of slowing growth.
Yeah. Yeah. I mean, essentially,
I could see a world where actually the supernova does better, and the Russell gets annihilated, for instance.
It could be. I mean, if the Fed is going to try to thread this needle that way and basically say, because I mean, the critique is simple. What are you guys, nuts? Credit spreads are down. Stocks are at record highs. You're cutting rates?
Right.
Are you out of your mind?
Exactly.
So the Fed has to make the case that, look, we know what you see. We're looking further, and what we see isn't good, in particular for the labor market. So we need to squeeze one out here, or two, or three, to kind of make sure that we're looking far enough ahead. If they can't sell that,
what does a lower Fed funds rate do for the labor market?
I mean, ostensibly, it lowers the cost of capital and lets businesses have cheaper financing, so their cost structure doesn't encourage them to fire, but maybe encourages them to hire.
Mm-hmm. And which industries are the most capital dependent right now that are even possible to hire? Healthcare. Like, let's just look at where job creation is in the U.S. economy. It's in healthcare and healthcare related services.
And government, yeah.
And it's in the government. Away from those two things, I'm not sure that there's any job creation.
There hasn't been very much, no.
And the government is utterly price indifferent to the cost of capital.
As we've found out.
And it's not, and I would say that in the scope of capital or cost of capital sensitive industries, healthcare is pretty low on the list.
Yeah. Yeah. I mean, the argument that the Fed has.
I understand like the academic argument for why,
yes.
But I'm saying in this economy,
it's not a strong argument, but clearly the markets think that there is a business cycle downturn that's coming, which is why they're calling for all these extra cuts relative to what the Fed is signaling. For whatever reason, the market thinks, look, the tariffs aren't the inflation issue. The tariffs are a growth issue.
Mm-hmm.
And whatever inflation comes of the tariffs, we don't have to worry about that being stuck because it's going to be so terrible for growth that the tariffs will become
The argument is
disinflationary ultimately.
that the catalyst for the rate cuts is the tariffs.
It seems this is what the
tariffs
markets
are a
think.
growth headwind.
It seems this is what the markets think, especially after the first 6 months of this year gave us the weakest consumption in 5 years, and the reference point on that is the first 6 months of 2020, which is the COVID lockdown. I mean, that's weak. That's weak consumption. Thomas?
So I mean, we've known a lot of this, and we know the Fed is going to cut more and more as we get closer to it. If you look at the Mag 7, it's sped up. It's had its best month since May. If you look at the Russell, it's slowed down a little bit. So I think, if you're going into it with the view that the Fed is cutting because of a weak labor market, I think you see the Russell having a negative reaction, and the Mag 7s just keep doing what they've been doing. Because it's not driven by a growth in the labor market, it's driven by investment and this sentiment.
And the rate of change of the AI adoption rate.
Right.
Yeah.
So I don't know if you really change anything that you've really been doing, if it's been working for a while. I'm not sure. I mean, that's a question that's going to be answered tomorrow. But you also have to account for the political pressure that it seems more likely by the day that there's going to be more influence over the Fed from the executive, especially next year. Moran is appointed. He'll have a vote.
He's
There'll
there.
be a
He's going to vote. He's going to vote at this meeting.
From what I've seen, legal scholars are pricing in more of a chance of Lisa Cook ultimately being able to be removed than it was just a couple months ago, even though an appeals court, 2-1 decision. I think the groundwork is being laid for ultimately for there to be much more political influence next year. And so the rate projections, if you're saying 3 this year and 2 next year, that might be undershooting it, because the administration is going to want more.
Yeah, I mean, this is where this gets interesting. So if you look at what policy expectations have been doing, you can sort of see this setup, right? So this is the December 2026 SOFR future, so interest rate futures. The way that this is quoted is this is the price of the future. The implied rate is basically this chart upside down. So if you're expecting more cuts, this goes up, right? Because this is cuts and this is hikes. So the way you arrive at the implied rate is you say 100 minus whatever this quote is. So in this case, it's 100 minus 97.1, say. But what you learn here is interesting in the sense that if you look at what this is, right? So this is the start of this year. Notice how much like the upside down of the S&P 500 this looks until you get to here. So this is stocks running up into a top. If you look at the S&P, it's almost the perfect inverse of this. Then at the beginning of the year, you get this growth scare. This is where everybody goes, oh my God, the tariffs, business confidence is down, consumer confidence is down. So this is mid-February to end of February right here. And just to kind of make this the most clear cut that it is, that's this right here. So where rates start going down, this is where the S&P starts going down, and this is mid to late February here. So this is then something of why this disconnect exists. Everybody gets freaked out about growth here, so rate cut expectations go bonkers. More cuts, more cuts, more cuts, more cuts. Liberation Day, all the cuts. and then things settle. And they settle, and they settle, and the rate cuts start going away until here, mid-May. Obviously, stocks keep going. Rate cut expectations just get built right back up. So whatever the market sees, it wants as many rate cuts now, give or take, as it did on Liberation Day. For the most part. There's these spike highs here. But the market clearly sees a growth risk of some kind. And when you look at the way these rate cuts are set up, certainly, to your point, Thomas, there's a sense that after May, you probably have a new Fed chair. Before then, you have a couple new Fed governors. They're going to dissent, even if Powell is able to essentially hold the line until May. After May, there's probably a new Fed chair that's more amenable. But the rate cuts are expected well before May. I mean, it's just cuts, all through the first half of next year. If you look at where things are baked in, they're relatively front-loaded. So the market thinks there's a growth concern of some kind here. Or at least that there will be one.
And obviously that's indisputable, and it's just perplexing to me that the U.S. equity markets are at or near record or all-time highs. Even the Russell's not far. I mean, none of these things are way off of a level, right? And yet the story is we're worried about slowing growth and rising unemployment. And so we need a rate cut. Well, if we're worried about slowing growth and rising unemployment, why are U.S. equities at or near all-time highs? How do you reconcile the different signaling? I'm not saying that any signal is even wrong. I'm not disagreeing with what you're saying the market story is. That's obviously is what the market story is. They believe there's slowing growth and a rate cut is in order. But what's with the rate cut at all-time highs? And if the rate cut is in order because of a growth concern related to labor and overall, let's say, a demand slowdown, how do you reconcile the anticipated demand slowdown with a market at all-time highs?
I think in my mind, if you look at what we just said, we said that rate cuts receded from the outlook as the market was recovering until about here, mid-May. And here you can see the stock market kind of stalls a little ahead of the former highs, ahead of the spot where it broke down, and then starts powering higher. And in this space here, rate cut expectations are building already. And so in my mind, this is, oh goody, cheap money. Whatever bad thing happens, there will be cheap money to tuck us in at night. And so until you get the big, scary economic outcome literally staring you in the face, which ostensibly we haven't had yet. We've had some bad jobs reports, but it's fuzzy enough, like ISMs are going up, S&P Global PMIs are going up, this Atlanta Fed GDP now thing is buoyant. Retail sales, for example, surprised on the upside earlier today. So until sort of the bad outcome, the bad growth outcome, you can see the whites of its eyes, as it were. The market's like, yeah, but cheap money, though. Cheap money's good. We're not going to spend the money on investment. If we look at the GDP flows in capital investment, obviously the hiring situation isn't good. You look at all of those things, it's not like people are going, oh, the money is going to be cheaper, let's run up the economy. So far, it looks like they're just running up asset valuations because the cheap money's got to go somewhere.
If you correct the growth fear now and the labor market stabilizes into next year, what happens when inflation starts going up because the labor market is strengthening in 2026? I think that's when the big sell-off comes. I don't think
That's
it's any
the
time
biggest
soon.
question, Thomas. That's the question. I think you've hit it right on the head, which is sort of why I suspect that the Fed comes out and doesn't endorse all this dovish signaling in markets, because it has that thought. And it goes, okay, so let's say we get a cut or two in here and we get this soft landing on course. What happens when year on year the tariffs go into the inflation data in earnest? And then what? Are we going to be in a situation where we have to hike? We don't want to do that. So let's not cut a lot. Let's cut a little and go incrementally and wait and give ourselves as much time as we can in between things, in between moves. And that's, of course, assuming that the politics doesn't get the better of them.
So this could be usually when you make the initial policy move, it sets a course, subsequent regular intervals of rate cuts or rate hikes, whichever you're doing. This looks like, assuming Trump's political influence doesn't go exactly as planned, where he has much more influence. This looks like it's going to be a cut, and then maybe one or two more cuts, and then uncertainty starts to build if we continue to get cuts in 2026. Mm-hmm. So once the market gets over these initial cuts and thinking we're going to stabilize the market, then you're looking into 2026. So I don't see a big sell-off. And when I say a sell the news event on tomorrow's rate cut, I mean a small dip, and then people start buying again, and we resume the bullish trend throughout the rest of this year. So I don't think that we're getting any big sell-off anytime soon. When I'm seeing, I see that coming next year, maybe as soon as May or June.
But you're saying it's an, oh my God, inflation is real. The tariffs did cause inflation. They never should have cut rates, or they're going to stop short. They're going to stop short on more rate cuts, because you're saying that you're going to get an April CPI or whatever. That's a beast. Or this is speculative, but some inflation data in the spring that's abominable.
I'm saying that's
the risk.
A risk that could happen.
Yeah.
And when right after you cut rates, and then all of a sudden you start seeing inflation go up, now you're in a position where, we just got done with the cutting cycle. Now we have to start hiking. The market is not going to like that.
No.
And that will come before the actual hikes are placed. It'll be when those rate hike expectations start building, or those rate cut expectations really start coming in after 2, 3, 4 cuts, and saying we can't cut anymore. That's when the market is going to feel the pain, I think.
So, Thomas, if you're going to get a little bit of a pull back on this basis, right? If you're going to get a little bit of something where the market goes, right, okay, we wanted this many cuts. The Fed is not going to give us this many cuts because they don't want to front run this risk that sometime in the first half of next year, inflation goes totally haywire, and then they have to look insane. So they're going to say, you know what, here's a cut. Maybe you get another one this year. Maybe you get a third one next year. For now, that's all we're going to tell you, which is what they did in June. So that was the thinking in June. So if this is what they do here, if all of this dovish rhetoric recently wasn't about our outlook has become dovish, it's, well, the calendar was running away from us. We only had the 3 meetings, and we told you 50 basis points going all the way back to December of 24. We only have but the 3 meetings to do those in. So we're going to have to change our tune a little to tell you why we're going to go and do it, right? So we're going to have to give you a little bit of a dovish Jackson Hole just to, set the stage here, because we are at record highs and credit spreads are super narrow and there is no immediate capital pressure, as it were. So, and inflation is well above target. So why are you cutting? if they're going to sort of give you that same song and dance and go, I don't know why you all think anything has changed. We're just doing the 50 that we said. So we had to change our tune a little, but that doesn't mean that we're forecasting any more downwind. Do you think there's a pullback here in the bonds? And is that then a buy? Because, I mean, the trend here is up, but obviously we've gotten stuck a little. And last week, I was coming up on DTE, so I took it off and ended up sort of riding it up to here or so. And I think the trend still makes sense, but the question becomes, do you then, on the basis that they're not as dovish as maybe the markets want, is there then a bond sell-off because rates come up and then you get a mulligan somewhere around here?
Yeah, I think bonds will keep going up for quite a while, but they have room to pull back. We've priced in this you know, as far as we're going to go 25, and then Fed comes out, say they imply that we could get one or two more cuts, but they always hedge, right? They're saying data dependent, going month by month. So I think there's room for bonds to pull back a little bit here. I'm not going to be playing a super aggressive short bond position. I'm going to be looking more in the equity market. I think it's a little bit more vibe-ish, if you want to call it that, or sentiment driven than the bond market is.
Hear ye, we have coined a term.
Right. Yeah. So yeah, I mean, I played bonds to the upside almost every time this year. I mean, last week I got out of the long ZB position. It did what it did. It gave me the position for a good profit. Got out. Now it's, I don't want to say overextended. I want to say it's at it's properly priced as of now.
Yeah. Dylan, are you doing anything in the bonds here on the idea that the Fed is going to disappoint, not with holy moly growth down, but with actually we're a lot more concerned about inflation than you all thought?
No. As you know, I've been obsessed with the not thinking trade, which has been stunningly positive, obviously, on the Mag 7 side. I've allowed myself to go into all sorts of thought as over the last 24 hours. And obviously, anytime you start thinking, the obvious thought is this is absurd and must come back down. I was sort of, I guess, I defer to Tom and Tony from the conversation in the last hour, which is, wait for more information and make your decision after the Fed decision. As far as the bond itself is concerned, having a point of view on whether this is going to be, growth is slowing or inflation is worse than we thought, I wouldn't begin to speculate with my own money or your money as to what that's going to mean for the bond. So that's a long-winded way of saying, no, I've done nothing, Ilya. And with the
let's
bond,
see if I can tempt you on the metals side, and I'll ask both of you. I mean, obviously, gold has stalled here a little. Silver has done a little bit more. It's pulled back here a little bit today. Moreover, it's setting higher highs, and the oscillator here, the momentum indicator, is not setting higher highs, which would indicate that there is some level of momentum loss. If we're going to get a Fed that disappoints markets, do we get a pullback here in your mind, Thomas, over the next day? And is that a buy, or is this one way to kind of get covered if the Fed disappoints? Stocks go down, maybe, but arguably so would these.
I'm long gold. So
me too.
The way I see it, what the Fed's going to do right now is we're getting the cut. They're going to forecast a couple other cuts. These rate cut bets are going to either stay the same or strengthen. There's uncertainty in the market, political uncertainty, uncertainty around deficits. While we have certainty that deficits are going up, we have uncertainty around the consequences of those deficits rising so quickly. So I think gold is, um, I'm kind of doing what Dylan's saying. I'm not overthinking gold. I'm just taking what the market gives me, and I'm staying long.
I'm doing the same thing. I sort of get the sense that gold is less about the immediate Fed outlook here and more about general uncertainty about what in the world is going on, including things like, is the Supreme Court going to strike down Trump's tariffs? And then what? And then it's like a mess.
Right.
And everything that we've spent 4 or 5 months attempting to benchmark is out the window. And it's all fog again. That seems like
and a
recipe for
I think
gold
probably
gains.
judicially, it seems legally that striking down the tariffs probably makes a tremendous amount of legal sense. And so it sort of comes into the debate between legal logic and partisan judges.
Yes. Yes. I mean, it'll be really interesting because these tariffs keep getting struck down, at least on the grounds that they were justified on. And now, at least the Supreme Court is going to rule quickly because they've said that they're going to issue an answer fast. But if they throw this out, I mean, does anybody really think that that's going to stop the administration from wanting tariffs? No, they're just going to go and try to look for other excuses.
But what is I guess you appeal the Supreme Court? Is that what the alternative?
I don't know that you can.
I mean, that was the whole point of the Supreme Court, was that that was the final court of appeal.
No, but you're right. But I think so the way that they've justified the tariffs, it sort of depends on the tariffs. If, let's say, you're talking about the aluminum and steel tariffs, they can cite one law and go, well, this is not a national emergency. This is not a risk to the sort of geopolitical posture of the U.S. What this is an unfair trade practice in a given commodity or in a given industry. And what we're doing is we're remedying that. And for that, you need justification. You need some sort of data. You need to be able to show it. What most of these tariffs are contingent on isn't that. It's that there is a national security emergency, and that's why we need most of these tariffs. That's the part that's getting overruled by the lower courts here. They're saying there is no national security emergency here. This justification doesn't work to let you have this authority.
I understand that. That goes. Every government, every dictator uses a national emergency as the basis.
Of course, it's classics. It's the classics.
101. I mean, that's what you do.
There's a great Netflix series called How to Be a Dictator, and it goes through some of the historical examples. It goes, well, if this is your set of circumstances, the way you'd be a dictator here would be like this, and national emergency.
That's like the go-to.
Yeah,
like
step 1
through 10.
Yeah. Yeah.
And so, it'd be interesting to see whether the Supreme Court is willing to consider the tariffs a solution to a national emergency.
Right. So my thinking is, let's say they get overruled on the national emergency. I mean, the administration is going to go and
says this is not a national emergency. Right. And then you're saying you got to go down the tariff list and be like, which one was implemented based on a national emergency?
Which is most of them.
And which one was implemented on some other basis.
Right. So all of the reciprocal tariffs, all of like the Liberation Day stuff, that goes away. And then the administration goes, well, can we sell it based on some other law?
I mean, isn't constitutionally, not to go all constitutional, but isn't constitutionally the Congress the tax policy maker of the country of the United States of America?
Which is why they have to get all of these tariffs essentially justified by existing acts of Congress and basically say, well, based on paragraph X of law Y, we can do this because
the authority was already granted.
The authority is granted.
The executive
blah, blah, blah.
branch has already been empowered based on this previous legislation to do this.
Yes, we can do this because Act whatever of some year gives us this authority on this basis. And what the lower court is saying is most of what you've done is on the basis of this national emergency power, and you can't show it, you can't prove it, there is no national emergency.
I would think the
Stop.
market loves it if the tariffs go away, even if it's a cloudy mess.
Probably.
I would think there's a bid across the board. I mean, my argument from the get-go is like, oh, well, the market's doing so well, the market's doing so well. And my counter, and I'm not my counter, but my follow-up to that sentiment, because obviously the market's doing very well, is imagine how well it will be doing without the tariffs.
Yeah.
Assuming they just don't find some other legal mechanism or pull something out of somewhere as they've done.
Well, obviously, let's assume they are going to find something, but whatever it is, it will kick the can on the amount of time that it will take for the tariffs to take all the effects that we, and more important than us, the Fed and the C-suite and the S&P 100 and blah, 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 that it'll take longer for whatever the tariffs are to be implemented or take effect just because of the muddling of the Supreme Court ruling. On the other hand, if the Supreme Court says, no, it's all good, I would think I would think the market goes down on a Trump positive ruling and up on a Trump negative ruling.
What's interesting is that if there is a Trump negative ruling, then we've got to pay back the money collected. If it turns out the tax was illegal, then the government has to pay it back.
All the money has to come back out.
So the government pays that back after they collected it. Then do they reimburse all the importers that have paid that? I mean, I would assume they have to.
Apparently, yes, from what I've read, which is incredible.
Remember, because the fee gets charged to the consumer, and then the company gets charged the tax. So I guess the money goes back to the company.
And then the consumers who have paid higher prices in places
probably don't get the money.
No, they don't get the money.
Which then,
we get checks back.
Again, so it's all the more reason why the balance sheets bump up on all these companies that have just jacked everybody for tariff fees that they then later got refunded.
That might be how this ends up being good for markets. Companies get a bunch of money back, and it turns out their margins are better because they've already started to pass on these inflation costs. Consumers are now starting to eat them. Meanwhile, they get reimbursed for at least part of what they got shaken down for.
But of course, they'll lower the prices right away.
Of course, that's always happened.
Mm-hmm.
Wink, wink, nudge, nudge.
Yes.
Gouging. What's gouging?
It's just unbelievable. When is that ruling?
They said they would rule by October.
So end of the month, or end of next month, I'm sorry.
Yeah.
So there's 6 weeks in there. I also wonder, because we're kind of far afield here, but Volkswagen, Daimler-Benz, Louis Vuitton, all the big sort of luxury and auto importers could be interesting. I guess they're probably not liquid enough from a trading perspective to matter, or all the sort of domestic tariff beneficiaries, all those American car parts companies and whatnot. Anyway, the Fed meeting is tomorrow. We shouldn't get too far into my little Trumpian Supreme Court speculation.
Well, to your point on the sector performance today, it's not the best mix, but consumer discretionary is up, consumer staples up. So doesn't look like the market is terribly concerned. I mean, I guess the retail sales numbers helped, but if you were going to bet that basically consumers are going to get left holding the bag, I suppose you could look at XLY and essentially say, like, okay, consumer discretionary is going to get hit the worst if companies do okay, but consumers end up stuck with the bill. So I suppose you could look for a top here, but there hasn't been anything smelling like one yet. The best performing sector today, though, Thomas, is energy, up 1.68%. And if we look at what's going on with crude here, it has a pretty decent day for itself. What's going on here? What do you think this is all about?
I'm still in my iron condor between 60 and 67.5,
Mm-hmm.
working beautifully over the past month.
Yeah.
There's inventories have been rising in the U.S. the past 3 weeks. Inventories abroad globally have increased on net. The IEA has come out and said, we're going to go into surplus next year. Demand is obviously slowing. So what's keeping the market up? It's geopolitical tensions. It's Ukraine striking Russian oil refineries, export terminals, things like that. And even without that, the expectations are that Russian exports are going to drop with Trump in Europe now. Europe may be taking a more aggressive stance against the purchasers of Russian oil, because we've seen for the past 3 years, you can sanction Russia, it works for a few months, and then they find ways to sidestep the sanctions. There's 1,000 different ways you can do it. So now you have to go to the purchasers, which might be a little bit more effective. It'll be effective for at least the initial period. It'll be harder to sidestep things like that. So, we are going to see Russian exports continue to slow down a bit. A major global producer that's helping keep prices up. But I mean, we're holding that 60 a few times over the past couple months. So it really seems like the market does not want to give up that 60, but at the same time, these rallies have sold off. So we're kind of in a balancing act between, expecting global oil consumption to come down and the impacts of, tariffs on Russia, Iran, things like that, and everything else. So it seems like, I'm going to continue to play for a sideways oil market right here.
I mean, it certainly seems to be fairly priced-ish. It seems to be kind of wedging up against that center line somewhere in this sort of 61.50, 62 area on the November contract, and it's just kind of stuck there. We can see it kind of riding those rails. We've got just a few minutes left here. Let's go around the horn. How are you guys positioned for this Fed meeting? What do you actually have on, Thomas? And then we'll go around.
In terms of equities, I'm only long Tesla. I'm long gold, natural gas, neutral on crude oil, long soybeans, long wheat, long corn. I'm trying to get out of Alibaba, iron condor. Chinese equities have, across the board, just rallied quite significantly over the past couple weeks. So that's really the only position I'm not working out on. I have a short call spread on the Canadian dollar. It's pretty much unchanged since I put it on last week under Chris's recommendation, but that's about it. I think I'm going to start getting a little bit more positioned for a dollar rally maybe into next week.
Oh, this euro broke my heart today with this rally. I'm still in it. I'm still short it, but my God, that's annoying.
Yeah, I mean, the euro is it's got some resistance coming up.
Yeah,
but a strong move today. I mean, 120 maybe. If it got up to 120, I think I might try to short it.
Yeah, I mean, it's interesting just before we jump over to see what Dylan's got on here. If you look at the kind of big picture here for the euro, and might have to go to the continuous contract here. Here we go. 120 is no insignificant level. So if you look at where the recent highs in the euro have kind of petered out, going all the way back to 2018 here, this line, that's just about 120 and some change, kind of depending on when you get there, right? It's a sloped line, which is not great. This is why horizontal lines are better. But by the time you get up here, you're looking at maybe something like this, like 120.20, 120.50. But you are seemingly near some kind of an inflection point sort of thing in Europe. So,
and if the tariffs are ruled, unlawful or whatever, it's time for a dollar rebound, especially under that environment.
I would think so. I'm now on both sides of the dollar for what it's worth. I'm short the euro against these highs here. It's really annoying that both on spot and on the continuous contract, it's actually broken them. But on the current active contract, no. So I'm hanging on by a thread here. I am long the pound, which is not that ticker at all. There it is. When the pound broke this range here earlier this week, I got a little bit long. It's had a little bit of follow through here. So I'm on both sides of that. I'm long the metals, both gold and silver, but also short the S&P a little as of this morning. Just basically looking for a little bit of a buy the rumor, sell the fact kind of a thing. Dylan, are you just throwing more money at NASDAQ in perpetuity? Is that what's going on?
You know me too well, good sir. For all of my gibberish about worry and fear and this and that, I have owned and delightfully, with glee and delight. So the best thing that happened, not to go gloat, but that Google Gemini thing a few weeks ago just about made me as happy as a clam. Still like I owned it before that pop. I started when I know thinking. I'm real the religion of the thoughtless.
Mm-hmm. Sort
of late August there, right into that, actually right before that downdraft. Anyway, I love Google. Right now I like Amazon. I own Amazon. That's a recent arrival. So Google, Amazon, Apple. I don't own Tesla. Kind of wish I did, obviously, after what just happened. Don't own Oracle after what just happened. But I would say I love the unloved, although Google is now loved. But I love the unloved of the supernova stocks at this point, with Apple and Amazon at the top of the list. I've owned Meta for a while, but I don't even consider that a trading position, and it wasn't real. Like that's not that I bought that's like an investment position, so it doesn't really count. I have nothing else on anywhere else. I don't have Microsoft. I don't have the Nasdaq. I don't have Tesla. I don't have Rivian. Google was my friendly neighbor. The dollar is the bane of my existence.
Can I get you into some Rivian since the Tesla
probably could. If you're going to
passed
anything, I think you probably could actually.
I mean, the IV rank here is not low, and so there's some room here.
Even some put spreads among friends.
Yeah, I mean, if you think that basically the supernova is alive and thinking is your enemy, which we can't deny has worked better than anything else by far. At least in the past 4 or 5 months at minimum.
Thinking has been, did you hear all the thinking I did today? It was catastrophic.
It's been although I am up on this year because the dollar bailed me out in the first half of the year.
You're plagued by thought.
I'm plagued by thought. My performance would be so much better if I, never mind fighting stocks, just didn't trade them and just was massively short dollar in the first half and then massively long bonds as I was in the second half.
But you got into
if all I did was that and forgotten that Wall Street exists,
your number would double for the year.
Fantastic.
Yeah, I know.
And with that, overtime is out of time. I'm going to try to lobotomize myself and forget that the stock market exists if it rallies in my face again tomorrow, which, as we know, likely. With that, we'll wrap it up here. We'll be back tomorrow to talk about what the Fed did and how painful all of it has turned out for all of us, because, of course, that would be the right Fed meeting to cause the maximum number of pain for all involved. Gentlemen, thank you. Don't go anywhere, anybody. I'll be back with a gruesomely exhaustive set of charts talking about this Fed meeting for macro money in just a moment.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
People are always asking, where can they find my podcast? There it is, son. Look at that. Option Trades Today. You can listen here.
And everybody's waiting for my podcast tomorrow. Option Trades Today, every Tuesday and Thursday around noon. If you want to learn, sir, every Tuesdays and Thursday, Option Trades Today. You can find me on YouTube or wherever you find your podcast.
Option Trades Today. You listening to me? Option Trades Today comes out every day around noon, every Tuesday and Thursday. You too can stick with the bat.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Delta, Vega, Gamma, Theta. It's all Greek to you. Well, guess what? Millions of people speak Greek, so you've got no excuse. Here's your alphabet. Theta is time decay. Time itself has value in the options world, and that value slips away the closer you get to expiration. Theta is how fast that happens. Tick-tock, time value drops. Delta is difference. How much does a $1 move in the underlying affect the price of the option? Long options have a positive delta because their value moves with the stock, and short options have a negative delta because their value moves opposite the stock. Gamma is get up and go. It's how fast delta changes. Gamma increases when the options start trading much more like the stock, like the closer to the at the money and the last few days till expiration. Vega is not a Greek letter, but it does start with a V, and so does volatility. Vega measures how much the options price is affected by the changes in volatility. Now you know your alpha, beta, gammas. Well, gamma anyway. Pretty simple.
So I started trading in the equities market when I was 18. Real basic ETFs, mutual funds. I didn't discover options and really Tasty Live until about 2012. it made sense to me from a risk perspective. And so I started trading and never really have looked back. The people you see that's who they are. They're trying to be as open and clear as they can with the trades that they're putting on. Teaching a methodology, like teaching the logic behind things. It is tried, true, and tested. They back it up with research. They share that research. It's not just trust us and do this, which is a very dangerous thing in the financial world. But learning about that in the Tasty universe, it starts to prove itself out, right? When you follow the methodology, you'll see those profits and you'll understand why a position did what it did. Sometimes the market wins and sometimes you have a 90% winner and you don't know, why don't I do this every day, right? This is easy. But you kind of have to reset that and just go, okay, close the trade and move on to the next one, which is really what Tasty's about.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities, and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you would like the chance to share your trading journey and inspire others.
The day is finally here. We are less than 24 hours away from this month's fateful Fed policy announcement. We're going to unpack what the markets are telling us ahead of that announcement and how they're positioned and what that means for these asset prices going forward. I'm Elias Spivak, head of Global Macro here at Tasty Live. This is Macro Money. And what we're going to do first is just take a look at the way the markets have been performing so far this week in the run-up to this major news. And then from there, see if we can't make sense of what is likelier than not to come next and take a look at what positions I have on to set myself up for what I think is coming. So let's go through here. There's a lot to get through, so we're going to move relatively fast. We have the performance today, not shocking in its sort of quiet and circumspect nature. We can see stocks kind of idling, the situation in bonds relatively muted, although we do get a little bit of a slide in front-end yields, ostensibly around the idea that we've had all this speculation around Fed policy in recent days. Last week, we actually had a little bit of a pickup in those yields here. We can see at the front end. And so perhaps the market's just evening out ahead of the event risk. The situation in crude oil still off on its own mission. A little bit of an upswing today, but price is still pegged near the middle of their multi-month range, and so not really going anywhere. Gold up narrowly, but a little bit soggier. Silver is down a little bit. The biggest mover really seems to be the dollar, which is absolutely shellacked today. This move of over 0.8% in the euro is a huge rally for something that is that big and that liquid of a market. And so big move for a one-day swing. The dollar likewise weaker against the yen. That's up almost 0.7%. And it seems to be lining up with the idea that the dollar has been relatively slow to fall, which we'll get to in just a moment, whereas the dovish positioning in markets has shown up elsewhere with gusto. We can see here yields have been falling. Last week it was a little bit of a pause, but before that we can see markets were clearly positioning for a more dovish Fed. But interestingly, the moves in the dollar were much more circumspect. In fact, when these yields had their biggest declines, the dollar actually squeaked out something of a rise against the euro, but on the whole sort of held up better than you might expect in this kind of an environment. And so a degree of catch-up certainly on the menu here today. If we look at the way the markets have behaved so far this week, pretty unmistakable. We're positioning for a dovish Fed, so yields are down on the whole this week. Stocks are up with the NASDAQ out front. Gold up, dollar lower, Bitcoin ultimately nowhere, and again, crude oil doing its own thing. So from the looks of it, we are very much positioned for the Fed to do something dovish, and that's what the markets are lined up here for. Now, as far as data is concerned, the only bit that we saw here over the past 24 hours, retail sales report, it comes in a little bit hotter than expected, 0.6%. The prior number revised up by a touch from 0.5 to 0.6%. So ultimately, we end up keeping pace, but what that ends up looking like is better results than what we initially saw reported for last month and this go round too. So for July and August, looking at the internals, probably the biggest standout here is that you get a big jump, a 2% month-on-month jump in non-store retailers, which is essentially e-commerce. And that's, let's call it, between 9 and 11% of the retail sales basket total. So not a negligible move. The biggest piece, of course, is motor vehicles. And here you can see things have cooled off, but that's after a very big jump in the prior month. We also have a relatively sort of healthy picture here on the whole for motor vehicles. Bit of a give back on durables like furniture, so high ticket items, but that's again after a surge in July. So on the whole, not the worst looking data by any means, but online sales and e-commerce, the standout, powering this better than expected outcome, seemingly. Now, the market is expecting the Fed to do something dovish all the same. We have here a set of expectations looking at Fed funds futures that have increasingly centered on a single 25 basis point rate cut. We can see here that yesterday the likelihood was lower by a touch that we'd get just one, and higher by a touch that we'd get a 50 basis point cut. A week ago, more so, the likelihood of a cut at 50 basis points was closer to 10%, and this was closer to 90. And what we see here is, as we've moved a week ago to a day ago to today, more and more certainty that we are going to get a single cut, less and less certainty that we're going to get a jumbo one. So the markets are pretty well anchored around, we're just going to get the basic version of what this is. And they've become increasingly convinced that that's the case over the past day and over the past week. The big disconnect continues to be what happens after this meeting, and that is probably the object of speculation. If the Fed delivers a 25 basis point cut, that is going to surprise nobody. But obviously, if we get anywhere on the extremes, the market sees 0% chance that there is no cut. So if there's no cut, obviously that would be a shocker. They see less than 4% chance that it's going to be a 50 basis point cut. So if it is, that's going to be a shocker. But if we're going to get the baseline 25 basis points or 0.25% cut, that's not news. Where there may be news is in what the Fed forecasts next, because this is going to be one of those quarterly meetings where the Fed changes, or at least reports on, maybe doesn't change, we'll see, but at least reports on their baseline economic forecasts. And this is not the Fed's forecasts, as it were. This is every member of the policy setting committee, the FOMC, gives their forecasts for growth and inflation and unemployment and the path of rates. Those get tossed into a hat and a median comes out. First a median range and then a median figure within that range. And that's what these forecasts are. And here there is a meaningful disconnect between what these policy officials have said and what the markets think is going to happen. Now, we can see here that the last time this was updated was June. The median rate currently is 4.4, so that the Fed called for 3.9 in 2025 means 50 basis points or half a percentage point in cuts, from 4.4 to 3.9. For next year, the Fed actually diluted its expectations and went from 3.4, that is another 50 basis points in 2026, to 3.6. That's just one cut. From 3.9 to 3.6 is a single move. 0.3 is obviously rounded off here to a single decimal spot from 0.25. So the market is at a single cut for next year, the Fed rather, was at a single cut for next year and two cuts for this year. That's 75 basis points in total easing through the end of next year. Obviously, the markets are at close to double that. And that is really around a much more expansive outlook in rate cuts for 2026. Now, you might make the argument that the Fed is already looking at 11 basis points of a rate cut, a third rate cut on the menu for this year. So that's 50 basis points in and roughly a 44% chance of a third cut. If we start to look at the way the cumulative data works out, it's actually higher than that. It's a better than even chance that you're going to get that third cut. But the real big disparity is for next year, where the Fed clearly is erring on the side of 3 cuts, and the Fed only has 1. And so if the move itself is a given, if the 25 basis points is whatever, because we know that it's in the price, the markets are certain, no shock, then the real question becomes, does the Fed move in any which way to endorse what the markets have or not? And does that occur perhaps in the summary of economic projections, or does it get talked about when Chair Powell takes the podium after the meeting for a press conference and explains all of what they do and what that signaling looks like? Now, why is this important? Well, we can see very clearly here that there's been something of a change in the relationship between stocks, in the blue line there is the S&P 500, and Fed policy expectations. We can see from the beginning of the year that they moved in tandem. So as we got stocks higher from mid last year into the beginning of this year, we can see cumulative rate cut expectations are going down. And we're going from as many as 6 cuts down to maybe 3. Notice this is exactly what the Fed is giving us as of June. So we start the year, we get the tariff rollout, the markets go, oh, whoa, whoa, business and consumer confidence doesn't like this, and right around here, stocks start to break down. Notice that's also the spot where policy expectations start to get more dovish. We start to get more and more cuts until we get to this bottom here in early April, where both policy expectations bottom out and so do stocks. They begin to recover in tandem as the markets go, oh, okay, This isn't our worst case scenario here, it looks like. And right up to here, they continue moving in tandem. What's interesting about this is this marks for stocks a recovery basically to where they started, where the breakout was, here. And from there, we can see the subsequent build higher in stocks comes not with policy expectations getting less dovish, but with policy expectations getting more dovish. In other words, if there was a positive growth story in the stock market, you would think you'd need fewer rate cuts because the economy is strong. That is not what's on the menu here. Very, very clearly. In fact, the markets are saying, actually, you're going to do more cuts. And at this point, we can see we're almost back to these Liberation Day extremes here. And that's not exactly a story about growth positivity, but it can certainly be a story about cheaper capital. And so if in fact we are going to get a Fed that does not endorse this expansive view of easing for next year, then perhaps the basis for much of what's occurred here since mid-May and through now is questioned. The dollar is at a similar inflection point. We see here that it started to bottom as early as July, and we're basically at that bottom here. We managed to hold up reasonably well as these expectations got more and more dovish. The dollar looked like it was attempting to bottom, suggesting maybe this dollar is ready to turn after an awful first 6 months of the year around these increasingly dovish expectations. But here, already as of July, we start to see things diverge. The dollar is attempting to stabilize. It's back basically at these lows here. And so a make or break point for the dollar here. And again, if the Fed doesn't endorse the expansive view of easing that the markets have, perhaps we get a dollar bounce. Why would the Fed not endorse the market's view? Well, we can see here that economic growth in the U.S. actually seems to be looking relatively better. Never mind the actual GDP forecast implied in this GDP Now model for the third quarter. It's far enough away that this model is going to change many times over. Notice instead that what the green line is doing is trending from the lower left to the upper right. That is to say, the tone of the economic data that gets fed into this model as it comes out has been such that it has increased growth expectations. But of course, the flip side of that is it's also increased inflation risk. And so if we look at minutes from the last Fed policy meeting, this is going all the way back to the July meeting, notice a majority of participants judged that the greater risk was upside risks to inflation compared with downside risks to employment. This is the last time that the Fed decided policy. It does see that the upside risk to inflation and the downside risk to employment are both elevated, but it sees the inflation risk as the bigger deal. Moreover, if we then look at what Chair Powell said at Jackson Hole, he certainly pointed out that risks to the labor market are rising, and this is why the market is looking at that speech and going, yes, this was stage setting for the cut that we're about to see. But also, effects of tariffs on consumer prices now clearly visible and will accumulate in the coming months. It's possible that tariff-driven upward pressure on prices could spur lasting inflation. We cannot allow a one-time increase in the price level to be an ongoing inflation problem. In other words, if the economy is seemingly holding up and warming up, and inflation seems to be starting to build from these tariffs, we just got a CPI report last week that gave us the fastest goods inflation in years, while services inflation actually came down. It wasn't anything catastrophic, but nevertheless, for 3 consecutive months now, goods inflation has gone up. The most recent numbers had the biggest increase in that goods inflation, and the year-on-year rate in goods inflation is at a multi-year high now. So, to Chair Powell's point, the effects of tariffs on consumer prices really are clearly visible. And if the economy is in fact heating up, at the very least, in making the argument here, as Chair Powell does, that it's unlikely that tariff pressure is a lasting issue. That in fact, weakening of the labor market will suggest that the economy will more so slow than become inflationary as a consequence of the tariffs, because they will hurt consumption. Consumption is the biggest part of the economy, 68%. If you hurt consumption, you hurt growth. If you hurt growth, you hurt demand. If there's weaker demand, there's less upward pressure on inflation. And so in hurting the economy, tariffs will actually be disinflationary. So yes, there might be a one-off increase here, but, and this is clearly the gamble that the Fed is making in issuing these cuts, the greater risk will be to growth downwind. It therefore makes sense to look through that inflation. That's the Fed argument here. Clearly, the markets are in line with that argument, and more so because they see much more easing next year, ostensibly on the same bet that the tariffs will be more damaging and more disinflationary through growth than they are inflationary by amounting to a sales tax on imports. If the Fed isn't prepared to go as far as the markets are here and is looking at an economy that's warming up, seemingly, we can see here, and is saying, you know what? We're not going to over-extrapolate. Here's your cut. We'll own up to one more this year. And we'll see you in December for a reforecast. In the meantime, you only get one cut that we're going to extrapolate for next year, because we just don't know what the inflation picture is going to look like, because again, we're more concerned about inflation than we are the labor market at this stage. If that's the tone, well, then stock markets are going to find themselves disappointed. And then perhaps whatever part of this rally is contingent on this starts to give way. And so with that in mind, what I have on here positioning wise, I'm on both sides of the dollar here. I'm a little bit long the pound after it broke out. I'm a little bit short the euro, so I'm straddling both sides of it, but ultimately looking for the dollar to start to bottom a little bit. But price action being what it is, if the pound breaks out, you've got to be on the other side of it. So here we are. The pound broke higher, so I flipped my short into a long, and it's working a little bit and helping to take some of the pain away from being short the euro here. This is a longer term position. You can see there's tons of days to expiration here. This is a longer term bet on Brazilian stocks. For what it's worth, it's working. Relative to the Fed, I am still long gold. I am still long silver, but I am now a little bit short the S&P. Just as of today, I have a little bit of a put vertical here that I bought. Vol is obviously very cheap. The risk reward is better than 2 to 1. Just looking for a little bit of a pullback. And so if the Fed doesn't disappoint, then the metals should work. And if it does, then there may be a pullback in the metals, but stocks on the short side should work. And of course, I'm on both sides of the dollar, so a little bit hedged there also. And that is how we're going into this Fed meeting, which for better or worse, may be a major inflection point for these markets, maybe for weeks and months to come. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also writing for the News and Insights portion of tastylive.com. If you're watching this on YouTube, like and subscribe. I'll be sending out the video of this and whatever other thoughts appear in my head at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky, so you can check me out there. In the meantime, good luck trading. Macro Money's back tomorrow.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80+ Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
What is going on, everybody, and welcome back to Risk and Reward. Today's Tuesday, just a day into the week. We got FOMC later this week, so maybe we'll get some things shaken up in the market. But before we get into all that, Gus, how are we doing today, brother?
I'm doing good. Pretty stable day. Got pretty much the nothing burger I was looking for in terms of what today brought on. I think we're all just sitting around waiting for this FOMC meeting. And yeah, it's an interesting spot we're in with the FOMC. I'm excited to talk about it here in a little bit. A lot of nuance. I feel like as the last week has transpired, all of a sudden this has come to have a lot more nuance to me, and I'm excited to get into all that.
No, me too.
What's going on, Bob? Happy to see you. I thought your comment about the Fed was very insightful, and I'm going to piggyback off of it here in about 15 minutes. Go on.
It's been so quiet. It's been so boring. Going into this week, too, on Monday, I already kind of knew, like, you know, it might be a slow Monday, it might be a slow Tuesday, and boy, it was a slow Monday and a slow Tuesday. Talk about watching paint dry, but I'm excited. I'm excited for the FOMC. I know we'll get into the details about interest rates, and I know today's a little bit more about, you know, the continued conversations on earnings and changing the time duration of that, but with FOMC tomorrow.
I was about to say Epstein. I was going to say, what the hell are you talking about?
No, those reports,
the New York
reports are not
financier.
dropping tomorrow. I don't know. We'll see. Will they ever drop?
Maybe sometime.
Maybe
Yeah.
never know. Maybe.
I would swap if I could trade the
those.
Fed.
Go ahead and drop those. Yeah.
We can push the Fed back a week.
Yeah. Fire whoever's in charge of those.
Just make it pay-per-view and then fund the government.
That would. Bro, you're speaking their language.
I'll pay $100. I'll pay $100 pay-per-view for the Epstein names drop.
Tax it, and they're dropping it tomorrow. If they can tax it, they're doing it. No, with that being said, I mean, I'm excited about the interest rates. I know we're going to get into more of that conversation here in a little bit, but potentially the first of many, maybe the first cut. It's been a while. I feel like I can't even speak that language here. I feel like we've been raising interest rates and raising interest rates and raising interest rates. So a pause would be kind of crazy. So we'll see if we get something in line.
Yeah, let's cut this thing 2 full points, I say.
Let's just blow it out the water.
Let's just blow it out the water.
Rip that Band-Aid right off.
Rip it off. Who cares about inflation? Are we a balloon? Just don't increase the prices.
No, just leave them alone.
Everybody unilaterally just don't do it. Money is fake. It's all fake.
Yeah, you go first. Keep your prices there first. No. No, with that being said, I mean, what do we got for today, Gus?
Yeah, we're going to talk a little earnings action today, but not specific stock earnings like you've maybe become accustomed to here on this stream. We have growing sentiment surrounding earnings requirements for companies potentially being cut down from quarterly to semi-annually. And so, yeah, there's two major sides to this equation here. But let's dive right in. So first and foremost, the proposal here is that President Trump is calling for the SEC to switch from quarterly to semi-annual earnings, as I just alluded to. And the logic there is that less reporting would save money, free up management, and allow executives to focus on operations and growing their companies rather than consistently trying to appease shareholders. And additionally, that goes into kind of everything. It's just that he thinks that companies are thinking too small because we make them report earnings quarterly. You're thinking on a quarter-to-quarter basis instead of trying to think about what we might do 5-10 years down the road.
Yeah.
So there's some institutional voices that have stepped up and shown their support. There's others that have spoken out against it. Warren Buffett, Jamie Dimon argued that quarterly guidance pushes companies into short-termism, which is kind of what I was just getting at there, only thinking about the next quarter and the next quarter and trying to issue guidance for those things and set goalposts. It can be challenging when you have to do it 4 times a year. So yeah, I mean, and it's interesting too. I mean, if I think about this like from a practical standpoint, I mean, if I were an executive, you know how annoyed you would be with earnings all the time because you got to be doing all kinds of prep. I'm sure like 2 weeks of prep for each upcoming call. You get people in your ear talking to you, and then you finally get through those 2 weeks.
You're the executive. I'm just devil's advocate.
I mean, no, it's.
But you're the executive though. You're getting $300K in your pocket. What you talking about?
That's true.
Make the earnings report.
I could pay you all more if I could focus on building this company instead of trying to speak to the damn public. I'm just gonna say I'm not gonna pay you more though. I'm just gonna increase my own paycheck in true executive fashion. But yeah, it's interesting.
Yeah.
A lot of takes. What's your thoughts?
Well, I mean, I guess we'll go through some of the pros and potential the pro change perspectives and then the anti change.
Sure, I'll give you pro change if you just want to go ahead for that.
No, we'll go ahead. Let me go through the second. We'll go through the second slide.
Yeah.
We'll toss back on some of these ideas that we have. But for the pro change perspective, focusing on long-term value as if that's not what the focus should already be. But less frequent reporting could reduce the obsession with quarterly earnings. There is an obsession in helping the CEOs prioritize strategy and innovation over short-term stock performance. So, I mean, I think there's a lot of truth to that. It's pretty difficult to refute any of those points being made. I think that's pretty valid. I would also say, I mean, just on the first point, I mean, those quarterly earnings probably come around a lot quicker than you even expect.
Yeah,
it's like you just had.
Yeah, that's what I was getting at. Like you do all this prep, and then suddenly it's like, oh my gosh, the next one's just here,
Right,
and
I mean,
all of a sudden.
I'm already thinking about just Chicago. Been out here a couple months now. I'm like, yo, in a month, that's already a whole quarter.
Yeah.
That's a whole quarter.
Yeah, and you still feel like you just got here, I'm
know.
sure.
Yeah. Cost savings. Preparing quarterly earnings is resource intensive. Cutting the frequency could lower compliance costs and encourage more firms to go public, addressing the decline in the U.S. listed companies, boosting revenue. No, I'm just like, I mean, if it's saving on costs, it's going to help the bottom line. And then international alignment. Moving to semi-annual reporting would bring the U.S. more in line with global practices, possibly making it easier for multinational firms to operate. So, I mean, being more conducive for other businesses abroad, those type of little details that I wouldn't think about right off the bat. But I mean, those are some of the pro-change perspectives.
Well, yeah, and
those
they
resonate with you the most.
And the UK and Europe do semi-annual reporting.
Okay,
is part of this.
So that was the first time, right? With what about the business in the UK? That's what first came to mind.
Like, how do you mean?
Is that just all of Europe, or is that sectioned off into?
No, I think that's a standardized.
Oh, it's a standard
EU UK.
We just do things different.
Yeah. It's just that their standard is semi-annual reporting. I guess you could report quarterly if you so choose. I don't know if anybody does it, but semi-annual is the law.
Yeah. Makes sense. Any of those resonate with you the most before we switch to the anti-change perspective?
I mean, I think the international alignment is an interesting angle, but ultimately, yeah, I think it's just the focus on long-term value that's a little bit bigger. Because, if you're thinking about trying to do something with your company that's going to cost a lot of money and it's going to make you look bad in the short term, but will do good things for your company in the long term, I think that if you were to go to semi-annual, it just really increases your surface area to be able to try those things. Because as opposed to, spending a couple $2 billion right now and then our earnings look terrible this quarter, you actually might have enough time for things to recover and start to look the way that you want them to look before you present them. And so you avoid the volatility in these giant swings in share price. And I know we're about to use volatility as an anti-point as well, that it could increase volatility. But while I think let's jump in.
Let's see that anti-change.
Let's just go anti-change perspective. So first and foremost is transparency and investor trust, and this one is the most valid anti-point to me. Quarterly reports consistently and clearly give investors a look into how the company is doing, and cutting down on that flow of information could allow for a little bit more malpractice. Right. I think about like an Enron. They might have been able to survive like 3 months longer before somebody figured them out at the very end there, if we were doing semi-annual. Also, risk of surprises. This is the volatility that I was getting at. Problems could go unchecked for longer, and then when they finally do drop to the public, could create bigger shocks to the market. And I think that would definitely be true. There's constantly, even now in a quarterly context, you still are constantly readjusting once earnings calls actually come out, trying to balance that sentiment versus actual fundamental it's a balancing act. Yeah. And then also checks on management. Frequent reporting forces accountability. Without it, managers might delay reporting issues and exaggerate, performance in the gaps. I think that's a very good one too. But kind of points 1 and 3 here kind of go hand in hand, where it all just comes back to transparency. And I think that would be the biggest danger, would be the loss of transparency.
Yeah, 100%. And at the same time, let me go back a little bit. Because I know we were talking about, put yourself in one of the executive shoes, what would be your perspective on it? Let me ask you this, put yourself in one of the shareholders' shoes. Let's say you're an investor, you're a shareholder. It's so easy to want to, and I know probably VCs and VC founders can probably speak to this, but I'm sure some investors are probably like, yo, what's going on at all moments? Are you working? What are you doing with my money? Are we making a return on this capital? Are things going to plan? So at the same time, I can see being an investor or a shareholder, you might want to have your finger on the pulse more than twice a year. But I know that's common standard in Europe, though.
Well, yeah, I can see that logic, but I would just counter with what I counter with now. Yeah. With anybody who owns anything and is waiting for earnings or feels like there's not enough transparency, why'd you buy it?
Right.
If you're convicted, you own it for a reason. You believe that things are going well, and sure, you would like validation on your sentiment that things are going well slightly more often. But ultimately, I don't think that it would really change much about the company. But I don't want to understate the dangers that could come into play with this, because when you have, say, like a Palantir sort of case where something is trading just so ridiculously ahead of its forward PE, first of all, it would become even more pronounced when they were reporting earnings less frequently. That would even further exaggerate how far ahead of their rear-looking PE, at least, they're trading at. And then beyond that, yeah, you would have this giant readjustment if they suddenly miss earnings and it's done 200% on the year and it's September, and then suddenly they have one bad earnings call, and you'd really need to rocket that back down to price that back in. However, are there not earnings surprises now all the time? Absolutely. That absolutely still happens. It's not like we're really preventing anything. There might be a few more, but markets are efficient. It'll figure it out whenever the information becomes publicly available, whether that's 3 months or 6 months.
Yeah, and my overall take on this is I actually don't even think it's that big of a deal, and I also don't think that a lot of the companies think it's that big of a deal where it's going to fundamentally affect the company somehow.
The companies would love this.
The companies would love it. If anything, the way that I see it is, Trump revives the push to end quarterly earnings reports the way that I see it is Trump's friends hit him up that own these businesses. Like, yo, bro, you know, it'd be sick if we can knock these down to, instead of quarterly, maybe annually. Like, yo, they do it over here in Europe too, and easy work could just be like, oh, you know what? We'll bring those topics back up. We'll look into it and see what we can do. And I mean, honestly, I do think like some of those ideas can be brought up in those fashions sometimes, just because, again, I don't think it's a big deal. So I think regardless if this goes through or not, I think companies are going to be happy. I think it'd be good if, you know, it's better on the whole morale. And
yeah. Well, I mean, the word revive specifically is being used because this was also something that he pushed for in his first term, and it just never was able to hold any water. However, I do think that your sentiment is probably correct.
Yeah, because I don't think it's a big deal.
But yeah, I don't think it's a big deal. And also, such is true with anything in politics. Right. It's all lobbying and who knows who and all that good stuff. So, but yeah, it would certainly, from a trader perspective, it would be a little bit less fun. You know, especially if you're one to try to trade 100%. Earnings volatility. However, is it less fun, or do we just consolidate the fun a little bit more? Because we're talking about probably more volatility every time there is an earnings call, and it's not like there wouldn't still just be constant earnings calls going off all the time.
That's a really good question. And I just wonder what my first thoughts are, you know, how are things done in the EU? That's just what I think right off the bat, because I don't know. Maybe it does consolidate into more of a bigger anticipated earnings to where we get a bigger outlier move. I
mean, I think that'd be fun. It'd be a little more, you know.
Yeah, I never thought about it in that way.
Yeah, and the seasonality of it would probably be a little bit more exaggerated as well, and it would be like a bigger deal. It'd be like the Super Bowl twice a year when Apple and Google and Meta and all of them report earnings at the same time.
It would be more of a fun event.
Yeah, that's true. Also, this also would open the doors for companies to just say, hey, we're going to report quarterly anyway because we want to do that for our shareholders, and then you can make yourself look good.
Well, now that I think about it, now that you bring the point up, I wonder why it hasn't been the case to where if you are a publicly traded company, why can't you do those earning reports whenever you so choose?
Let's do it once a week.
I mean, if you want to.
If you want to.
If your CFO is cracked out of his mind on caffeine, and he wants to pull up these reports for you every single day, I mean, who's gonna?
Here's our guidance for tomorrow.
Who's gonna I'm hired on the spot. Like I'm trying to, you know, be friends with that CFO too.
Yeah, we're not gonna give any guidance for Thursday just yet. We're uncertain of how Thursday might look, but we're pretty sure about tomorrow. Yeah, no.
I mean, I don't even doubt. I know we've seen AI thrown in the chat quite a few times here. I mean, I don't even doubt if we start building things where AI is able to track the financial health of a lot of companies. I mean, at the snap of a finger. I mean, who knows what's being built right now? But I did see that AI would help create more of an efficient process in terms of like gathering all these quarterly earnings reports. So I want to be certainly as time intensive. I did see that. That point.
I think that's a great point. And Mike, to your point here as well. No testing, no cases argument. You just say everything is great if reporting is less frequent. Next employment CPI and all that will also be, BLS, Bureau of Labor Statistics. I thought you might be getting a little profane there, Mike. All that BLS info will be 2x a year. I think survivorship bias, I think is what I would call that. Formally. But yeah, I think that's a very good point as well. Although it's not like you could keep it away forever. I mean, I gave the Enron analogy. It's like take this and impose it onto Enron. How much further do they really make it? I don't know. Maybe a few months, and that everybody gets burnt the exact same way. And that's like, you know, the most hyperbolic case you could possibly have. I blocked your camera there. My bad, man.
Oh, good, bro.
I'm getting all animated. I threw my arm into Errol's camera. But yeah, so I think there is an argument to that. But yeah, I mean, the information would still come out. It would just be less frequent. And yeah, I do think that there would be a lot of the sky is falling, but the company just says everything is fine.
Yeah, I also just think that.
But also, that's not really wise, though. You don't want to be the company that makes headlines because you misled your shareholders for 6 months and then your earnings call pulled your share price down 22%.
No, but I think, no, you don't want to do that, but I think it gives the opportunity for somebody to slip up and start. Oh, it's not a big deal. 6 months, twice out of the year, I can get away with this.
I don't know. I think at a certain level, and obviously this has been proven wrong a lot of the time, but I think at large, like on average, in aggregate, when you're talking about these multi-billion and trillion-dollar companies, it starts to be like court. Like there are a lot of times with a lot of cases in court where somebody could perjure themselves and no one would ever know, but you still don't because they might. Right. And so I think there's always like that. It's like, the more if you're going to lie, you got to have a good memory and no whistleblowers. And that's hard to do if you're a company the size of like NVIDIA or something, for instance. Well, not the largest company in the world, Broadcom. I'll pull a company out of my ass. If you're that size, that stuff all just gets harder and harder to, keep track of. But I do think that that's a very valid point. But holistically, yeah, I would say I think I'm a proponent on this. And it would be interesting to see if we could implement this. It would be interesting to look 5 years down the road if companies are actually growing faster. That's really what I would like to see, is if there's a causal relationship there.
Are you saying if we did go to the annual or semi-annual?
Yeah. If we switch to semi-annual and then 5 years down the road, we look at the data, is it actually
I know it's
helping?
two different markets, but can we not split test some of that right now with semi-annual earnings over in Europe? And
I'm sure you could.
Compare and contrast.
I'm sure you could take the largest food distributor in the UK and compare that to the largest, Tyson
I
or
feel
somebody.
like before you do something, that's like the best way to go about it. It's like, who's done this before, and what, I know we have different variables, but it's like, what's the closest?
Yeah, that's true. Yeah, I'm sure you could find even just two comparable countries and like A/B test that.
Yeah, curious about the sentiment. We can jump over here in the platform. We'll do a little tour to market. I know we got less than 10 minutes left. We'll get a little bit of a grasp on the market heading into Wednesday. But no, with the EU earnings, I'm even just curious on what the sentiment is with trading some of those earnings over there. Like over here, it's such a thing. Oh, it's earnings season.
Yeah,
like, we got a name for earnings season.
Yeah,
trading earnings.
Yeah, I mean, it would even just like, with the increased volatility, because the information is coming out less, it would certainly make trading earnings a little more exciting. I mean, your winners, your losses can only go to zero, and that will happen now. But your winners could be much bigger.
It could be a lot bigger
if you think about it. So,
as you can see, SPY going on in an absolute tear. I can't believe that's still April. We keep referencing that the beginning of April, and I mean that really put in the low, and it's not even close since. So. Markets at all-time highs right now. Volatility index hasn't been able to budge as much lately, but we're getting a little bit of a perk. It's perking up a little bit in there, Gus. Maybe we get a little bit of a run in vol here soon. We do have FOMC coming tomorrow. And again, last time we even seen vol expand past 30. I mean, 29.82 was in April. Let's take a quick look at gold. I don't know if anybody else has been trading gold or any of these other metals. Gold's still going. Gold has been a blast. Gold has been going absolute mayhem. Can't stop, won't stop on gold. But that being said, with gold, we saw the out-of-the-money call spread. We got Google. We got NVIDIA. NVIDIA, after all this time, NVIDIA is sitting at break even. Sometimes you're in some of those trades, and it's like it's been a month or two, and now we're break even. QQQ sold an out-of-the-money put spread, sold an out-of-the-money call spread, kind of legged into like an iron condor type thing, different expirations. SPY, another out-of-the-money call spread, and then I bought. This one is different. This one's actually a little bit more of a unique position, which was SQQQ. SQQQ. Yeah. This is the inverse ETF for QQQ. So whenever QQQ goes up, SQQQ goes down. QQQ has been going ham to the upside since April. So SQQQ has been going ham to the downside since April. So you can kind of see there's like a direct inverse correlation. And we'll talk a little bit more about these triple leverage ETFs too. So bought an in the money call there, and that's how I'm playing this FOMC instead of more short delta. Got on some long delta and SQQQ, Gus. But
yeah, I think that's an interesting way to attack it. Yeah, I mean, that's one way to go about it. I like these leverage ETFs, but I just never really like them in an options context because I always feel like options give me enough leverage anyway. I don't need leverage on my leverage. Very seldom would I want to put myself in that situation.
Right.
But yeah, I think it's a fun one, and I would assume, well, obviously there's more leverage, but I would assume you can get a little bit more leverage on it with it being $18 a share.
I'm sure we can figure something out.
There's some delta adjustments.
I'm sure we can figure something out and crank some more delta in there.
But in regards to FOMC though, I'm an advocate for kind of the exact sentiment that Bob was outlining earlier. I think this FOMC thing, it's turned over to me now to where it's so certain that we're getting a cut and everybody is so excited about that there is nothing that the Fed could do tomorrow to keep the market green tomorrow. That's where I'm at. The analogy that I just gave Errol while we were off air is it's like when NVIDIA has an earnings call and we know that they had a great quarter and everybody knows that they had a great quarter and that they're going to beat analyst expectations. And so then it goes up and up and up and up running into the earnings call. And then they do beat expectations, but not by enough, not by 100% on EPS and revenue. And because because of that, it actually winds up dropping to price in the beat. And so I think we could be in a very similar situation to that here with the Fed, where everybody is so excited about this cut and so amped up, and we've been running up for a week, that when the cut actually comes through, I don't know that there's any meat on the bone left for this to go higher.
So I'm of a very similar-ish proponent, just from a slightly different angle. More so of the proponent of, or of the angle of, if we don't get what's in line, I think that's where we see an extra boost of chaos.
Sure.
Let's say even if we don't do anything, I think if we don't cut or raise, all hell breaks loose.
Oh yeah, no change.
We cut 50, all hell breaks loose.
No change would be
go in
catastrophic.
line, absolutely.
50. I think 50 is the only
50's
situation.
aggressive.
I think 50 is the only situation that could possibly move us higher,
Yeah.
because that would be beating the expectations,
Yeah.
as like, to go back to that analogy.
Yeah.
But I think that's the only way that we could actually go higher. But assuming that markets are efficient, and we have a lot of data that says that they are, the publicly available information is that there's a 96% chance that there's going to be a cut tomorrow. And so I would assume that there is about 96% pricing in complete for that reality. So it's an interesting situation. I'm certainly not, well, I am insanely long, as I always am against tomorrow, but I have not put on any further long delta trying to take advantage of this cut.
No, I got you. Bob Saw said, I told you short gold is your own risk. I'm a gold bug. Gold is an absolute monster. I think gold was trading at a very narrow range for like the last couple months, but when gold moves, gold can move.
I remember that gold was the first stock my dad ever told me about.
Was it?
Yeah, like ever. He was talking about gold. He was like on his phone sometime when I was like 6 or whatever, and looking at some stocks, and I was like, oh, what's that? He's like, oh, it's the stock market. And then, yeah, the analogy that he gave, well, not analogy, it was true. But he was like, you see, like here, I own gold. But that was a terrible example to give to a child, because I was like, there's no gold. There's no gold.
There's no gold.
How do you own the?
Yeah.
You own a little bit of
sliding me already?
The gold is somewhere else. Like it really didn't compute. I can remember really having a hard time with that, my little 6-year-old brain. And then he was like, then he did the whole, explain stocks to a child, where he was like, okay, imagine a company, and we cut it up like a pizza.
You go by here,
and then everybody gets a piece of the pizza. And then it made sense when he actually did it in like a company context. But yeah, gold, it was confusing.
I was pretty fascinated by gold from a young age, like just the material. I don't know what it was, just the conditioning or whatever it was. Shiny, shiny object syndrome. But shiny, and then watch some movies with. What's his name? As we come to a close here.
You looking for like?
What is his name? I used to think he was Bill Gates.
Can you name a movie?
Yes, he's literally one of the most. And it's so funny because growing up as a kid in elementary school, I used to think that was Bill Gates.
Everybody submit your guesses in chat for what actor Errol is talking about right now that he thought was Bill Gates.
I haven't given a lick of a description.
No, you haven't.
What I'm talking about.
You haven't.
Just an actor.
We're talking early 2000s prominent male actor. That Errol thought was Bill Gates.
And so the other day,
is it Matt Damon? Like I don't.
Oh no, it's not. I seen us going back and forth in the chat, and somebody brought up a band and they got it. So I've seen this done before. I've seen, what's that band called, and someone got it the other day. But
can you name a movie that he's in?
Yes, and we'll have to return. We will return, and I'll remember, and I'm going to bring it up. But I think it's because I got to think about it right now.
He'll remember the second we get off
Nicolas Cage.
Oh, Nicolas Cage.
Nicolas Cage. There was a movie.
National Treasure.
National Treasure.
I know exactly what you're talking about now.
Exactly, National Treasure. That's exactly what it was. Anyways, great movie.
You thought Bill Gates stole the Declaration of Independence?
Bro, I didn't. I was trying to figure out why he was trying to do that. Just buy another one. No, I was like 6'7". I was like, Bill Gates. I don't know who said that. 6'7". I can't.
If anybody in chat gets that, I would be impressed. That's the most chronically online shit I've ever done in here.
Oh, I love it. No, not Fabio, not Austin Powers, Milton Berle, Gold. These are great guesses. I appreciate the help.
Fabio. We went Bill Gates to Fabio. Honestly, Bill Gates and Fabio are maybe as close as Nicolas Cage and Bill Gates.
Might be as close as we're getting. With that being said, we are coming to a close. Anything else to add, brother?
No, I don't have anything else to add. I did. I had something really witty prepared like 15 minutes ago. I was like, oh, that'll be my last thing, and I forget it. So everybody at home, laugh like I said something funny.
That was definitely me.
I had something cooked up there.
Yeah.
The number 7 was involved.
6'7".
I was gonna say Yeah, I don't know, guys. I'm not good at outros. Everybody laugh. Thank you, production team.
I'm no orthodontist.
We're pretty true professionals around here. Orthodontist.
Like, I'm no orthodontist. It's like, huh?
What?
That's the point.
Oh.
It's like, I'm no rocket scientist, but it's like, that has nothing to do.
Oh, you just mean because that's the saying, but we could just kind of say anything?
It's just one of those very sarcastic things like, I would help you, but I'm not a dentist. It's like, I don't need help.
I don't play tennis, bro.
It's like, bro.
I don't play tennis.
Exactly.
Oh, heck yeah, Bob. Happy to hear you'll be in New York. Yeah, that's going to be a great event. We're real excited. It's waitlist only, so if you got on that main list, congratulations.
Oh, yeah. With that being said, that's going to wrap up today's segment. We will be back here on Thursday, 4:30 Central Time. Be sure to come hang out with us. We do have FOMC interest rates tomorrow. We'll see how we're hanging in there. We'll circle back around, give an update. But thanks for taking the time to hang out with us. We will be back with more segments. Be sure to stay tuned for more segments coming on next. We'll catch you guys next time. Peace.
The market does